Welcome to Morningstar. I'm Larissa Fernand, and with me today is Prashant Jain, the Chief Investment Officer and founder of 3P Investment Managers. Today, Prashant will share insights with us that go beyond the role of analytics in money management. Prashant, thank you so much for joining me today.
No, my pleasure, Larissa.
Thank you. Prashant, I would like to start this conversation by asking you how you have evolved as a money manager, from managing relatively small amounts of money to managing the largest mutual fund in India. Surely there were psychological and mental changes. So do tell.
No, Larissa, to be honest, I don't think I have changed much emotionally. And when I look back, I think I've always tried to act rationally. And whether my views were aligned to the market or were contrarian was just an outcome of that process. I think I've always tried to think long term. I have taken risks when the potential returns justified taking those risks. And I think what I can say in support of this is the fact that pretty early on in my career, we faced that IT bubble, and I was quite raw, to be honest. But I thought those valuations could not be justified, and the fund weight significantly underweight that stock. That put immense pressure on the performance, but I held on, and over time, of course, the outcome was good. And the same thing was repeated in around 2007 and last few years in different sectors. So I think I've always tried to think long term, think rationally. What has changed when I look back is that my understanding of businesses, my understanding of people, my understanding of the way markets function, and my understanding of the way economies function, the way we are, the way global factors affect us. I think all of that has improved. My ability to understand a new business has evolved. Today, I am able to understand a new business much faster than what I would have done in the past. But I think at core, I think emotionally, I think I remain the same. Maybe my ability to handle stress has improved, and it would be very hard for me to measure that myself. But the way I handled the underperformance around COVID, when we were exposed to the economically sensitive sectors, I think I handled it better. Way back in '99, when we sold technology, I was unable to sleep at night. But this time around, I think that way I was quite stable and had a normal life.
But your sense of responsibility has always stayed consistent, whether it's a small amount or big amount.
Oh yes, I have always thought in percentage terms, and that is what I encourage everyone to think. So whether it was a 70 crore fund when I was starting off, or whether ultimately they grew to almost 1 lakh crores my own funds, I have always thought in terms of percentages, and I have always ensured my interests were fully aligned with those of investors. I was investing my own money in the funds, so I don't think much changed despite the significant growth in size. Of course, the number of scripts, when there were opportunities, a small fund you could run maybe 25 odd stocks, and in a larger fund you will need 30, 40, 50 stocks. But that's a more outcome of the size and not of the way you are thinking or acting.
You still operate in a fiduciary capacity, but has there been any mental shift from moving to the mutual fund space, from the mutual fund space to the AIF space?
So, Larissa, I think you would agree, and most would agree, that the way I ran mutual funds also was probably not the typical index hugging style. And what people called it risk, I thought it was not risk, but trying to capitalize on opportunities when there were big values available in few pockets. I did not shy away from betting large amounts of money, of very large funds also. So almost 10%. of these large funds was in one single stock. And to that extent, I don't think much changes between managing an AIF or a mutual fund. My style, I think, will remain the same. I hope to make lesser mistakes going forward because of the experience that one has. And I also think in an AIF, since given the nature of this product, uh, you can focus more, you can attract more people who are more aligned to the way you hope to manage money. And that in this case means that we are targeting specifically the more patient investors, the investors whose return expectations are realistic. Of course, we ensure complete alignment of interest with the investors once again.
Yeah, in the mutual fund space, you had to manage a lot of expectations, right? From everyone.
See, mutual fund is a public vehicle. There are the number of investors is probably 1,000 times what you would get in an AIF, and especially in a large setting like HDFC. It's a mass brand, universal appeal. So the number of investors there is very large, and it is extremely hard to connect with those investors. So, of course, in every communication, I took the care to focus on long term, to communicate reasonable expectations. But still, investors being so diverse, they will come in with their own assumptions, expectations, views, etc. So there, I don't think a manager has much control. But here, I think one can definitely communicate a lot more. I would not say better, but more effectively, because the number of customers is much less, and therefore I think it is possible to align better your strategy, the way you are thinking, with the right set of customers.
Prashant, you've always been an investor of great conviction. So, how do you balance rigidity and conviction? How do you know where to draw the line to not let your ego come into play? How do you guard against this?
Conviction and rigidity are probably two sides of the same coin. I mean, if you are convinced about what you are doing, then you will stay the course, and that many can perceive as rigidity. The converse viewpoint is, if you are not sure what you are doing, then the market, whenever you are faced with the adverse market conditions, you will change your positioning. A portfolio manager, and also in life, whatever one thinks is right, you must stay the course. And I think you can be wrong for two reasons, in life and in markets. You can be wrong, either your views were wrong, your conclusions were wrong, and in that case, I don't think being rigid is right thing. But you will know only your views were right or wrong when the outcome is there. So at least in my case, when I stayed the course on 3 4 occasions over last 30 years, when views were different from the markets, I think the longer term outcomes were they proved that the initial views were correct. So whether it was selling out of technology, whether it was not participating in real estate NBFC's power in 2007, or whether it was staying the course on economic sensitive sectors in COVID, which included PSUs also, the performance recovered on the same stocks which caused the pain. So, but at the same time, I think I have been open to contrary viewpoints. In fact, I have always sought those viewpoints. And in my earlier company, we had a process, I think maybe it is still there, that we always encouraged meeting analysts who had a contrary opinion to ours, and we used to document those views. So whenever you were faced with the valid, logical views, and you thought they were right, we did not hesitate to change. And there have been cases where I have moved out of stocks at significant losses also. but those are not known to the markets because these mistakes were small. But fortunately, the bigger bets, which were more visible, I think most of them turned out to be correct. And so I'm conscious of this human flaw that all of us have big egos and we need to keep it in check. And more so in our case, when you are managing not just yours but someone else's money as well.
Okay, so just to take off from what you were saying, you did avoid certain bubbles, like whether it was the NBFC bubble or dot-com bubble or power or real estate. But when you do so, the returns take a hit in the fund. Conversely, when you invest, say, in PSUs and the market does not appreciate at the moment, your returns take a hit. Who pays the price for your conviction and how do you deal with this?
Lisa, I think we must segregate short term pain and long term pain. Pain that is temporary and pain that is permanent. Avoiding a bubble is the best that a manager can do for the long term investors. So I feel actually happy about it. And that pain was worth it because the pain that is caused over 6 months, 1 year, when the tide turns, you gain immensely. So I have never shied away from avoiding temporary pain. In fact, such occasions are the best time for a good manager to stand apart, to distinguish himself. Because whenever the market is very polarized, either on the upside or on the downside, there is a big risk in a bubble or there is a big opportunity in what is good but is hated. And I think at times like these, the short term pain will lead to very decent, very solid gains over the medium term. So I would look for such opportunities and I would try and capitalize on them again and again. So whether it was not being in the last 6 months of the IT bubble or the pre 2000 pre Lehman in real estate NBFCs, this pain was temporary, but look at the subsequent years, the gains were huge. And similarly, in the case of PSUs, while I don't think in terms of PSUs and private, I think in terms of good businesses and weak businesses. But yes, what happened around COVID is that most PSUs, rather all PSUs, are in economic sensitive sectors. You will not find any PSUs in the consumer space, the pharma space, or the IT space. So when the economy was hit, economic sensitive sectors were hit, almost all PSUs were hit. The markets did not realize it is happening to those sectors where they are present. Rather, they thought it is the PSUs which are bad. I think that created immense opportunities. And if you look back, we doubled up in some cases, and ultimately these companies have gone up in some cases 3 to 5 times. And today you can see they find wide acceptance in a number of mutual funds, and most brokerages are extremely positive at 5 times the prices. So I think such pain is always welcome, and investors who are investing in a strategy like this should evaluate the outcomes of such strategies over long periods. And so I don't think there was anything amiss in that. I would actually look forward to such opportunities again.
Did it not give you sleepless nights when it was the short-term pain?
No, of course, as I said, in 99, I found it very tough to sleep for weeks. And around 2007, it was slightly less. Last cycle, I was quite relaxed because I think by that time, your understanding of the businesses or your understanding of the markets, how markets can be mispricing assets for near term, I think all of that had improved considerably. And that is why we not just held on to those positions, but actually we doubled up in many cases, despite the considerable pain. And what you lose in 2 years, you gain back in 6 months, 1 year, several times over. As I said, my ability to handle underperformance has probably improved over time. Yes.
Okay, I get your conviction, I get your courage, I get your the way you've handled it. What makes you insecure?
I am always, not always, but many a times insecure about my conclusions around our business. It is, there are both good and bad sides, positives and negatives in that. So if you are insecure, little insecure about your conclusions, I think it will keep you open to contrary views. You will seek out contrary opinions. You will be open to change. The negative side is that if you are too insecure about your conclusions, then you will tend to get influenced a lot by the price movements, and you will not be able to handle short term gain. So I think a little insecurity is good. When you keep on revisiting the same hypothesis with multiple people, you keep on reading, thinking about it, over time your understanding improves. At the same time, one should not be too insecure, otherwise your portfolio turnover will be very high and it will lack any direction.
You've had a fantastic run, and while I acknowledge your analytical ability and even your prescient insights, how does luck or gut feel play a role in the big scheme of things? Does it?
No, I think whether you call it luck or you call it destiny or you call it karma, I mean, it matters less, but I think it plays a very important role. So when I look back at my career, I think luck has a very important role to play in that. And some small events, they change the course of your career. It has happened to me. So I think it is extremely important. If one appreciates the role of that, it helps you be humble. So I think we cannot and should not take credit for all that we do. At the same time, I mean, despite your best efforts, your outcomes may not be as good. So if you believe in the role of luck or destiny or karma, I think it will enable you to handle even those outcomes with greater fortitude and better.
You said something about small instances which could you could consider as luck. Can you just name a few or name one?
See, I had written the civil services way back, and I answered one question correctly. It was for 60 marks, and my English was poor, and I forgot to read the Hindi version of that question. So after solving it, I realized, I thought I had misinterpreted the question. So I cancelled it and resolved it. If I had just read the Hindi version, I would have solved it correctly. And the first time, what I had done was correct, but I lost 60 marks because of that. And because of that, I did not get the my choice of services in civil services. This whole process delayed my joining SBI CAPS by 2 months. And when I reached SBI CAPS, Mr. Shriram, the GM, he said, "Son, I am extremely sorry. The choice postings are gone. All I can offer you is equity research at SBI Mutual Fund, which was a division of SBI CAPS." Now, that is what set me on course to become a money manager. So that, one small instance of you misinterpreting a question altered the entire course of your career. So this is one of the examples, I mean, I can never forget, and a good example how small incidents can change the entire course of your life. And actually, the note which I wrote, SAR, about my journey in the capital markets, that opens with the same line, what Mr. Shriram told me way back in 1991.
I'm very glad you answered that question wrong. Many investors would be glad.
No,
So I
me
think,
too.
Prashant, that's about it. Thank you so much for your time.
No, Larissa, thank you so much. I thoroughly enjoyed this interview and wish you and your viewers all the best. Thank you.
Thank you. Thank you for watching Morningstar. I'm Larissa.